I put $100,000 into the Nasdaq 100, and every month I pulled out $500 to live on. That's a 6% withdrawal rate, and the Nasdaq's long-run return is over 15% a year. So that's easily sustainable, right? 5.5 years later, the balance was zero. Wait, the asset returns 15%, you take out 6, and you go bankrupt? How? And here's the part that makes no sense. Someone who ran the exact same strategy, starting 7 years later, never went bankrupt at all. They ended up with over $500,000. Same asset, same amount, same withdrawal rate. The only difference, the day they started. One goes broke, the other ends up with hundreds of thousands. That's not bad luck. It's a structural problem. In this video, I'm going to show you, with data, why this happens, and how to avoid the trap. This phenomenon has a name, sequence of returns risk, and the core idea is simple. When you're withdrawing money while you invest, what matters isn't the average return. It's the order the returns arrive in. Let me show you why. First, look at the crashes the Nasdaq has actually lived through. The dot-com bust, down about 80%. $100,000 becomes $20,000. And it took almost 14 years just to get back to even. The 2008 financial crisis, minus 53%. The 2022 inflation shock, minus 35%. And if you add up every month QQQ spent more than 15% below its previous high, that's 180 months, about 15 years, nearly 60% of the entire period, underwater. Now let's add withdrawals. You put $100,000 into the Nasdaq in 2000, right near the dot-com peak, and you do nothing. Yes, it falls to 20,000. Brutal. But if you just hold and don't sell, 25 years later it's about 8 times your money, over $800,000. See? You just don't sell. Right? If you don't sell. But now take out $500 a month. You're bankrupt in 5.5 years. $300 a month? Broke in 9 years. Why does it die so fast? Here's the mechanism. When the price is down 80% and you pull cash out, you're selling shares at a fire sale price. To raise the same dollar amount, you have to sell more shares. So when the price finally recovers, there's barely any seed left to grow back. Just don't sell only works if you can actually not sell. For anyone who has to pull money out every month, a retiree, it doesn't apply. And by the way, even the famous 4% rule goes bankrupt in QQQ only, 9 years. You'd have to drop to 2% to survive, and 2% of 100 grand is about $170 a month. You can't live on that. Now, some of you are thinking, fine, so just hold some cash, live off the cash during crashes, and never sell the QQQ. Reasonable idea. I ran the simulation. Start at the 2000 dot-com peak, set aside part of the 100,000 as cash, put the rest in QQQ, and during crashes you withdraw from the cash. 2 years of cash, $12,000 set aside. You go broke in 7.5 years, about 2 years longer than with no cash. 5 years of cash, $30,000. Broke in just under 10 years. 10 years of cash, $60,000. Broke in about 15 years, even 14 years of cash, $84,000. You still go broke. Why can't you cash your way out of it? Because every dollar in cash is a dollar not in QQQ. Stack up 14 years of cash, and your QQQ allocation is barely 16%. It cushions the fall, but the recovery has almost no compounding power. Eventually, withdrawals win, and the account slowly bleeds to zero. Cash earns 0%. It doesn't offset the loss. It just delays the bankruptcy. It's not a seawall. It's a sandbag. Okay, counter number 2. Then switch out of QQQ into a high-dividend ETF. Live off the dividends, never touch the principal. A high-dividend ETF like VYM yields around 2.5 to 3%, but a $500 monthly withdrawal is 6% a year. The dividend doesn't even cover half of what you need. You're already short before you start. But here's the genuinely shocking part. High dividend equals safe is an illusion. In the financial crisis, QQQ fell 53%, VYM 57%. The high dividend ETF actually fell more. Why? Because VYM is heavy in financials. In 2008, bank stocks were obliterated, and the high dividend ETF took a direct hit. The correlation between VYM and QQQ is 0.74. One means they move identically. 0.74 means they're practically the same body. Stocks are stocks. A stock that pays a big dividend is not somehow immune to a crash. And the returns? From 2007, $100,000 in QQQ became nearly $2 million. The same $100,000 in VYM, about $540,000. Worse defense, worse returns. High dividend is a choice within the stock bucket. It is not diversification. You have to understand that difference. So what's the real answer? The key is to hold something that goes up when stocks crash. Look at the correlations. QQQ and long-term Treasuries, minus 0.03. Essentially unrelated. QQQ and gold, 0.06. Also basically unrelated. Let me show you how that actually works. The simplest possible diversification. Nasdaq 100, long-term Treasuries and gold, 1/3 each, rebalanced. And we'll start it in 2000, top of the dot-com bubble. During the dot-com crash, 2000 through 2002, while QQQ fell 77%, Treasuries rose 24%, and gold rose 13%. The 1/3 each portfolio, down about 26%. Still ugly, but a completely different universe from minus 77. Now, the financial crisis. October 2007 to early 2009, QQQ down 44%, while Treasuries rose 19% and gold rose 24%. The diversified portfolio? Down 2%. It barely moved. This is where cash falls short. Cash returns zero, so it only defends. Treasuries and gold rise when stocks fall. They defend and earn at the same time. Now the main event, the withdrawal simulation. Worst possible timing, the 2000 dot-com peak. $100,000, split 1/3 each, pulling out $500 a month. QQQ only went bankrupt in 5.5 years. The diversified portfolio? It didn't go bankrupt. 25 years later, it still holds $165,000. Even at its lowest point, it kept 59% of the original, $59,000. Change the withdrawal rate, and the result stays dramatic. The classic 4% rule, $330 a month. QQQ only goes bankrupt in 9 years. The diversified portfolio survives with $426,000 left. Push it to 6%, and the blend still survives. Past 8%, the blend goes bankrupt too. But it still lasts about 14 years longer than QQQ only. Start in October 2007, right before the financial crisis, and the blend wins again. QQQ only didn't go bankrupt this time, but it fell to 45% of the original at its worst. The diversified portfolio bottomed at 80%. It kept 4/5 of the original. 80% is a level where you can hold on without panicking. Why does this work? Because when stocks crash, you sell the treasuries and gold to cover living expenses, so you're not dumping stocks at fire sale prices. And when stocks recover, the stock sleeve pulls the whole portfolio back up. That's what real diversification is, not mixing stocks with more stocks, mixing assets that move in different directions. And now there's a twist. But doesn't diversification lower your returns? That's what people assume. The data says the opposite. Look at the no withdrawal version, just holding from 2000. 100,000 in QQQ only became about 820,000 over 25 years. The same 100,000 in the diversified portfolio, nearly 970,000. The blend made more, with 1/3 of the drawdown. In annualized terms, QQQ at 8.5%, the blend at 9.3%. The blend is still ahead, and it got there with a maximum drawdown of 30% instead of 80%. Why does that happen? Because after QQQ crashed 80% in the dot-com bust, it took almost 14 years to get back to even. For 14 years, compounding wasn't working. The diversified portfolio only fell 25% over the same stretch and recovered much faster. So compounding kept running the whole time. That's the real power of diversification. Falling less is earning more. Mathematically, lose 50% and you need 100% gain just to break even. Lose 25% and you only need 33%. The smaller the loss, the faster the magic of compounding kicks back in. And a bankrupt portfolio's return is minus 100%. A dead portfolio's compound return is meaningless. You have to survive for compounding to work. Let's bring it together. The Nasdaq 100 is a great asset, but hold it all in while you withdraw money, and depending on when you start, you can go bankrupt. Stacking cash only delays it. Switching to high dividend actually falls harder. The answer is Nasdaq, Treasuries, and gold. 1/3 each, rebalanced. And the surprise is that mixing it this way doesn't cost you returns. From 2000, QQQ only did about 8 times. The blend did almost 10 times. The blend is actually higher, and the worst drawdown dropped from 80% to 30%. And it doesn't go bankrupt even at a 6% withdrawal. The enemy of investing isn't a low return. It's running out of money at the wrong time. If this video helped, hit subscribe and like. Thanks for watching.